Welcome to the Trust Us, We're Professionals podcast with your friends from SSC CPAs and Advisors. This is the podcast where we break down financial matters found in pulp culture. Basically, we make complex financial matters more consumable for our listeners. And we're all financial professionals here, which hopefully makes us qualified. I mean, I guess a doctor that smokes is still a doctor, right? I'm your host, Chris Underwood, a financial advisor with SSC Wealth, and I'm joined by Chris Cohart, an accounting genius, and special guest, Erica Dvorsky, the Chief Operating Officer at SSC and an expert in strategic planning and nonprofits. All right, Chris, Erica, thank you so much for joining us. Tell the people why you are expert.
This might be the first time I've ever been called a genius. I try to play that off for my daughter, and she rolls her eyes, so I appreciate that. My name is Chris Cohart with SSC CPA and Advisors. I'm a CPA who has 20 years of accounting experience, and I've been doing not-for-profit accounting and auditing for, I'm pretty sure, all 20 of those years.
I'm Erica Dvorsky, Chief Operating Officer at SSC CPAs and Advisors. I spent 15 years before coming to SSC in nonprofit management. I learned about accounting and financial management by trying to explain them to my 36 bosses, also known as a board. Understanding the money is critical for any business, but nonprofits and their staff, board members, and donors should especially know how each dollar functions within their organization.
Thank you. In today's episode, our second, or 102 if you're keeping track at home, we are going to do something cool. We're going to explain the complex revenue rules for not-for-profit organizations using an equally complex rule, the NFL catch rule. Is it a catch or is it no catch? I'm sure most people know this, but just in case they don't, the NFL was actually a not-for-profit organization from 1947 until they finally relinquished it in 2015. And it was basically just because of mounting public criticism as why is this billion-dollar league a not-for-profit? But the Green Bay Packers still retain their not-for-profit status. Technically, they have shareholders, the fans that own the team. So, Erica, I would love to hear your expert insight as to how the NFL was ever a not-for-profit. I mean, or how was it? I mean, how could they even navigate that or make that work? And Chris, you too. I mean, it just seems absurd to me.
And it does sound absurd. Really, what's important to know is that they were income tax exempt. The status that they held with the IRS made them exempt from paying income taxes on their income because they were an association meant to serve a particular membership. Any association that serves a particular membership can make its income tax exempt if that is their status. The NFL never had public charity tax status, which allows organizations like United Way to provide a tax-deductible contribution. Now, they are not tax exempt, and they can't provide a tax deduction, but they were never a public charity offering tax deductions. Anything to add, Chris?
I think that's an important distinction. The difference, this broad statement of what is a not-for-profit or a tax-exempt organization, and there is different types. And the United Way, where we give contributions to, is one type. So I think it is an important distinction to note that it's not the same as United Way. I couldn't have given money to the NFL and taken a tax write-off for it.
Damn it. No, that would have been great if you could have gotten, the red zone and write it off on your taxes.
Right.
And I think that's an important distinction. I think a lot of people, the general public, I mean, I'm a financial advisor. I'm not an accountant, but I think the general public kind of views, all nonprofits the same, not-for-profits the same,
right.
Like they all are like a church when it's not the case. They all kind of different and there's some nuances to it and what they can and can't do.
Yeah, there's quite a few 501c designations. They're not all 501c3, which is what the general thought or view of a not-for-profit is a 501c3, which is what Erica was talking about as the publicly supported, where we're getting to take a write-off for the charitable contributions we make to that organization. But it still makes it odd that the NFL, as much money as they made, was still a 501c.
The optics of it are just, the optics are so bad. I mean, like the fact that they just, just let it go for so long. But I mean, at the same token, in their defense, I mean, if someone said, "Hey, you don't have to pay as many taxes," I'd probably be like, "Okay, yeah, sure." You know what I mean? All right. Well, let's talk about some famous catches versus no catches. In history in the NFL, and then trust me, we will tie that back to financial matters. I promise you.
What we're going to attempt to do today is to correlate catch rules versus nonprofit revenue recognition. That's the creativity that we're going to have today.
And it's creative. It is, or at least what we like to think it is, because we wrote it.
When we talked about that, Erica was like, "Yes, I love the NFL, and this is exactly how I want to talk about not-for-profit revenue recognition."
If it was up to Erica, she would. If it was socially acceptable to come into the office every day with a Chiefs logo shaved in her head, she would do it.
Because when we're talking about whether it's a catch or no catch, or whether it's revenue or not revenue, it's a call. You got to make a call. And I think that's part of what is important for financial accountability across the board. Sometimes you just have to make a call. There's a lot of definitions involved, but that's part of what our expertise brings to bear is how do we get to those definitions? So we're going to show you all how good we are at making the call by illustrating it with our NFL referee years down the road expertise.
That's right. That's right. What they just said, they said it a lot better than I did.
Yeah.
All right. So full circle. Let's start with some famous catch versus no catches. Okay. We'll talk about it and, get our 2 cents. And then, like they said, we're going to correlate it back to not-for-profits. So Bert Emanuel, 1999 NFC Championship game, Rams versus Buccaneers. Chris, have at it. You know exactly what I'm talking about.
Yeah. I still contend that it was not a catch.
I totally disagree. It was called a catch, and then they pulled back on it. But his hands were underneath it, both hands on the ball, totally had possession.
It looks like a catch when you watch it live.
I don't like the Rams, so I've chosen to.
Okay, so that's where this is coming from. It's got no basis.
I get it.
It's just purely.
I'm using the ambiguous nature of some of the rules to say to satisfy my personal feelings, which is not how we normally make decisions. But in the Bert Emanuel catch, at that point, I was.
But that is how fans make decisions.
Yeah.
Very not rationally. So he is actually Bert Emanuel is from Kansas City, Missouri. I did not know that, and he actually has an NFL rule named after him.
Yeah, I think this is where the catch versus no catch really began.
I agree with you.
Was after this, and that's why he got a rule named after him. I don't think it's probably the most famous at this point, but it's kind of I think the very first one never is quite as famous as one that is maybe more prevalent.
Sure. Yeah. This is the kind of catalyst that kicked it all started, or got it all started, I should say. The other one I was thinking about, this is, kind of infamous too, because I remember them calling this the Calvin Johnson rule, was 2010, was a regular season game, Detroit and Chicago. And for those of you that don't remember, do you know what I'm talking about, Erica, Chris?
Mm-hmm.
Yeah.
I do.
He catches it. I mean, his bottom hits the turf. It looks like a catch. And then when he's kind of like rolling over, I mean, he made a football move. He's, his butt hits the ground. He rolls over. And then when he rolls over, 2 or 3 seconds later, that's when the ball pops out. I think it hits the ground, right?
Yeah, he kind of puts the ball on the ground to kind of prop himself back up to do his end game celebration.
It didn't look like he ever lost control of it.
Right. And it seemed like when he put the ball down, he just let go, and then he went into, I just won the game, and this was awesome.
So the lesson that I take from this is when you celebrate too early, sometimes the deal isn't done.
Yeah.
So in the tie to revenue, you might be really excited as a nonprofit executive that you just scored a really big gift, and you start leaping up and down, and then you say, oh, and expletives come out of your mouth, and all of a sudden the donor walks away. That revenue is not really revenue at that point.
That's right. And Calvin Johnson started celebrating with his teammates, and they went to the booth, and nope, it wasn't a catch.
Yeah, and you know who's always that's the accountant inside the not-for-profits. Like, well, hold on a second, executive director. I was reading these rules, and I don't think this is revenue. That's the referee.
That's
hold
the referee.
On a second.
Yeah. The review booth too.
I was thinking.
Also the review booth.
Now, I think this might be the most infamous, or whenever I think about catch versus no catch in the NFL, this is what I always go back to. I'm somewhat of a Cowboys fan. I grew up in Oklahoma, so you either love them or hate them, or sort of in the middle, which is me. Dez Bryant, Dallas Cowboys versus Packers, 2015 NFC divisional game. I think it's like fourth down. It's like 4th and 10 or something like that. And I mean, you would think they were just trying to get a first down and keep going. Romo was the quarterback back then. Threw not a Hail Mary, but close to it. And Bryant made a heck of a play and looked like he came down with it. It looked like it was a catch. I mean, I think the Packers were even like moving to the, like going down the field to set up for like a goal line stand. But again, it was reviewed, and what do you guys think?
Well, I would say what was interesting about this one is literally he's laying on his back and it pops out and then comes back again. So he actually had possession, then didn't have possession, then had possession again. But the whole time he's laying on the ground. So if he had possession at the beginning, does that count? If he had possession at the end, does that count? He did lose possession in that window of time.
True. I think it was a catch. I contend because we can always juggle, but as long as the end result is possession, I think that qualifies us as a catch.
And is that because you like the Cowboys?
I hate the Cowboys.
Okay.
Which teams do you like? I feel like you hate a lot of teams, but so tell us who do you root for?
The Chiefs.
That's it. There's got to be another team.
I like the Bears as well. I do really like the Bears. I don't know why.
I like the Packers too, just because it's
I also think that something important that note of all. There's big things on the line in most of these instances, and I do think, as Erica was saying, when you get that donor that gives you a certain amount of money or a big gift, there's a lot on the line in that situation. The financial viability of the organization, the success of the organization, and you being able to fulfill your obligation to that donor or the donor's intent is important for you to be successful, to make that catch, to consider it revenue, to be a successful victory on 4th and 20 to make a game-winning catch or not.
It would be nice, though, and I'm thinking about this, since we're talking about, not-for-profit revenue recognition, is that if we had a referee pull out some sort of card that has a decision tree to determine catch versus no catch, right? As it relates to, not only the NFL, but also for not-for-profit, for revenue recognition. Can we just go down that a little bit, the decision tree, and kind of what that looks like and what some of it means? Because clearly I don't know. So what is, like, for instance, what does exchange versus non-exchange?
Yeah, there is a decision tree as it relates to revenue recognition, and it's part of the ASU 2018-08. And I would love to see an NFL referee pull out a sheet of paper like this every time a catch, and they just have to say yes, and then they go over to the next part. So did they have this? No, and then they go down, and then we can just, very objectively say this was a catch or no catch. That'll never happen. And I'd really like them to have it up on the monitor as they walk through it too. That would be fantastic.
That'd be good for the fans, actually.
Yeah, absolutely.
It's like a multiplication table. You just connect them. Yeah.
So the decision tree for a not-for-profit as it relates to revenue, it kind of starts with a starting point of whether it was an exchange or non-exchange, like Chris had said. And sometimes people refer to that as reciprocal or non-reciprocal. And that's more about whether it's a donation or did I provide a service? Did we provide a service?
Did you get something for it?
Right. So a lot of times with those not-for-profits, it's kind of hard to determine whether we got something or we didn't get something for that. And it has to be of commensurate value. So it has to be worth what that person was giving to us. So a lot of times we know that, hey, I've gone to a charity event. The table was $1,000, but I got a meal out of it. Well, that's not equitable value for what you gave for them. So that wouldn't be an exchange transaction. That would be considered a non-exchange transaction. So that's the first decision you have to decide is this an exchange or is this not an exchange? And if it is an exchange, we got something for it, then that goes into a whole different world, ASU 606, a whole different revenue recognition model for contracts with customers. Now you may not have a contract, but you still have to go under those rules. And then once you've said it's not an exchange, we're a non-exchange, then we have to say, okay, well, is it conditional or is it unconditional? And that's where you end up starting to get a little bit more in the weeds. And I think I I viewed exchange versus non-exchange as kind of, it's a pass, it's a catch. It's just what kind of catch is it? Is it a shovel pass or is it a traditional forward pass? Like it's still a pass and it's still going to be a catch, but you may not think of them the same way.
And I also think it's important to think about, why do we care what kind of, if the money's coming in, why do we care what kind of money it is? Well, the reason why we care is because traditionally, historically, charities and nonprofits, their revenue primarily came from contributions, free will contributions that people gave to them. As donors have gotten more and more savvy, smart about about what they want to do, sometimes they say, well, I really want to accomplish this thing, and I'm going to ask this charity to accomplish this thing for me, and I'm going to give them the money to do it. So that's part of the why that we care about exchange versus non-exchange. Was there a specific request tied to this that is absolutely tied to getting something back?
Right. And getting something back sometimes is hard to determine, because if it's for the general public, like there's a general public benefit for it, even if you did give something back to that organization, if the overall good is for the general public, that's a completely different kind of analysis. That would be more of a non-exchange, even though something came back to you.
And an example of that is a foundation or a donor might say, I want to pay this charity to do this research and publish this report that then goes into the public domain. That's for the greater good. That's for everyone. It's not exclusive to a specific third party. But when we shift into talking about conditional versus non-conditional, then this is, if you don't do it, then what?
Okay.
What's the consequence of not doing it?
It seems very subjective.
And if you didn't write the report and there's stipulations in the contribution that said, and if you don't write this report, we're going to ask for the money back, then that's part of the stipulations.
It's kind of like the referee in football.
Correct. Yeah. And what Erica was saying is important. For it to be considered conditional, it has to have a right of return or right to cancel payment, future payment, and it has to have a barrier. And both of those have to be written. The barriers, I think Chris was saying, that's where some of the subjectivity could come into, whether someone deems that a barrier or not. It's really easy to see whether it's written in that they have a right of return or right of cancellation of future payments, but that barrier is really important to determine whether it's conditional or not. And if you don't have either, then it's considered unconditional.
Which is the favorite money of all nonprofits everywhere.
Yeah. It's just like unconditional love. There's no conditions on it.
Exactly. It's just a catch.
Yeah, exactly. Yeah. No matter what. It's always a catch. Yeah.
Caught the ball, you ran down, you made a touchdown.
Right.
Nobody's questioning it.
Okay, so we have exchange versus non-exchange. It's sort of like you said, whether it's, it's a catch, but are we arguing semantics as far as like it's a shovel pass versus a regular pass or something like that? We have conditional versus non-conditional, which is sort of where the subjectivity comes in a little bit, and it's sort of, this would be like the equivalent of like who the referee is. And then, am I missing anything? Is there...
Yeah, we still haven't quite decided whether we're going to recognize this as revenue or not. We still haven't. So if we've said, all right, it's definitely a non-exchange, and we've said it's definitely conditional, now we have to determine is if we've deemed it as unconditional, we can then decide, is this restricted or unrestricted? And now Erica looked at me because I used the wrong words. It's with donor restriction or without donor restriction is the new terminology we're using. And at that point, that's what's determining whether we're recognizing that as revenue and when. So without donor restriction, we're going to put it on the books as revenue, but it has a restriction. So we only recognize it as regular revenue in our unrestricted pool once we've used it for the purpose that it's been stated, or there's a time has been released of us using it. So you can't use this until 2021. Okay, once 2021 hits, we can recognize that as unrestricted revenue. So ideally, Erica, we want non-exchange, unconditional, and unrestricted.
Absolutely.
That is the holy trinity for not-for-profit donations.
That's the dream.
Yeah.
That is the dream. But the fact is, as I mentioned, a lot of donors are really savvy. A lot of organizations are really savvy, and they're reaching out to donors and finding out, what do people want to accomplish? What are they hoping to accomplish? And so some donors might say, I really want you to double my money. I'll give you $50,000, but I want you to match it with somebody with other dollars. So then you can't recognize that revenue until the match has been raised, because if they stipulated that, it's very important that they can actually take that back if you don't raise the additional revenue. So it all ties to what it is you're trying to accomplish in one way or another. But I think the other piece of it is that by recognizing it as revenue, then it becomes an important tool for the organization to be able to make progress on their mission, as opposed to, but when it's just held as an asset, they can't actually make, that isn't income. It just, you gotta imagine. It's a little bit like your 401k before you reach a certain age. Don't touch it. It's going to hurt if you touch it.
And in Erica's example, it's a perfect example, because we've got a right to release that future payment of $50,000, and it's written. And we also have a barrier, a measurable barrier, that I have to get to $50,000 of matching funds before that person's willing to give me the $50,000. So we have both things to make it conditional.
So did we ever decide if it was revenue or not?
We kind of do, yes.
Yes and no?
Yes and no.
Yes and no.
I'm always a big yes and no. Now, if you do get to conditional, so we've got a non-exchange, and in Erica's example, we've got a conditional. So we can't recognize that until we've met our barrier. So once we've raised that, then we'll recognize it as revenue. Now, that doesn't mean that we're out of the water yet, because we still then have to make the determination as to whether that's with donor restriction or without donor restriction. So we still have a lot of paths to get to just to recognize it as that kind of ordinary unrestricted revenue.
And the match part is one specific barrier, but another way that you could have it is that it is purpose restriction. We want you to use this on, my dream, overhead and administration, so that you can manage your organization effectively. Nobody actually designates dollars that way, but they could restrict it in that way and drive it there. Then that restriction will need to be met as the organization kind of continues to do its work. You can spend down that money by paying your administrative salaries. And so that would be one way to meet that restriction. It gets released just as it's used for that purpose.
Right. So we have quite the stair step on our decision tree.
Yeah.
But wouldn't it be great if the NFL refs followed a similar stair step when it came to the Dez Bryant catch?
I think it's a really good analogy, though, because it really does seem like, I mean, the catch versus no catch is complicated, and this is complicated. It's not, but it is. You know what I mean? It's something simple that, seems very obvious. Well, it's a catch or it's not, but just how the NFL has made it nuanced and layered. This is nuanced and layered. And now we've asked about, revenue versus not revenue. Maybe it'd be better if we did some specific examples, and you guys can say this is revenue or a catch or not a catch, right? Because talking in broad terms, it's hard to make a determination, right? So I'll give you guys some examples. I had a team of monkeys put these together. They worked on them all week. So you guys listen to all the little details and then tell me in your expert opinions what you think, if you think it's a catch or no catch. So a couple, we'll call them John and Jan Smith, pledge $2 million to help their local nonprofit private school build a new football locker room. The school has design control. The first installment is due upon completion of architectural design. The final installment is due upon the school receiving a permit of occupancy. If the school is unable to receive a permit of occupancy within 2 years of architectural design, then John and Jan Smith are released from their obligation to make the final installment.
That was a lot of info.
Well, I think we need, it's like determining a catch. You need to see it. I need to paint a picture. You need an image,
Well, we know that it is a contribution, and it is a contribution, and the benefit is a subset of a third party. So all the students in the school basically are getting the benefit of this. So that means that it would be a non-exchange, because there's not a very our specific subgroup getting access to that.
Yep. John and Jane Smith are getting nothing in return for their $2 million at this point. So,
except the knowledge and potentially their name on the building.
Potentially their name on the building.
Yeah.
But that's intangible.
Yeah. So first off, I agree. Yes, we are considered a non-exchange transaction. So we don't have to deal with 606 rules, the fun contracts with customers, and we're now sticking with our general contribution decision tree. And now we've got to go down to conditional versus unconditional.
And I would say it's conditional, because clearly they've put stipulations about what they're going to do with the money. You don't get to use the first $1 million on
overhead.
On overhead. No, they've stipulated that very clearly.
Yeah, I agree. Both there's two barriers here that I see. One, we do have a written release of obligation for them. But we have a stipulation that we have to get architectural design. So that would have to be the first barrier. So if they gave us $1 million up front, that would still be considered conditional contribution. It's kind of hard because we receive the cash, but it would still not be revenue for us until we receive the architectural design. Now, in theory, the way that you were saying it, they would give the first $1 million upon receipt of the architectural design. So somewhat there that we have kind of a simultaneous release that, yes, it's conditional. The full $2 million pledge is conditional, so we don't recognize any of it, but we've got the $1 million. We've met the condition, which is we've achieved the architectural design. Then I would probably say that at that point it's unconditional, but it has a restriction that we have to then use it on the building. So if we don't build the building thereafter, then we would still have to return it because it isn't being used for the right purpose. And then the last being definitely conditional for the remaining. So if they never get the occupancy, even if maybe that first $1 million they did spend on the building, then they've met the restriction and they wouldn't have to return that. But that last $1 million, if they never get that permit of occupancy, they would never receive that extra money. So they could spend $2 million on this building and only have received $1 million from this donor because they never received a permit to occupancy.
And I think this is, in some ways, this example is a nice lesson for anyone who's interested in making a very targeted gift, to actually have some of these stipulations mapped out, especially a time boundary. Because if there's not a deadline, we sometimes don't always get things done.
Yeah, we could have ended up in a pandemic and
not happened.
not built the building after all.
Exactly.
So catch, no catch, revenue?
I'm saying it is no catch at this point until we receive architectural design
and get an occupancy permit.
Yes.
It's
So there'll be multiple
Then
catches.
it'll be a catch.
Then it'll be a catch.
Right. This guy's juggling it a lot. So this is like a 2-year juggle job. This is Des Bryant on his back.
Bryant.
This is on
his back, and we
kicking
can't
around,
quite
yeah.
tell. And maybe he caught it first for the first $1 million, and then he lost the ball, and then he caught it on the last one.
I like that, actually. All right, so here's another scenario. Let's go through it again. Catch versus no catch trivia. So we'll call this not-for-profit Healing Fans from Playoff Loss, Inc. They receive a grant from Referees Are Us. Referees are us. They put their pants on one leg at a time. So we've got Healing Fans from Playoff Loss Incorporated. They've received a grant from Referees Are Us Incorporated to perform a study on the effect of work productivity after NFL playoff losses. The grant is silent on right or return, and Healing must provide a report conveying the study findings, but the study remains the property of Healing. You need me to get an abacus?
This is essentially this is a non-exchange. I mean, because they're not getting tangibly anything out of it. It is restricted, but it isn't conditional because there's no return.
I would agree with that. I think that there's a lot going on here. But right off the bat, it's not an equitable exchange, so it's definitely not an exchange transaction. There is no written right of return, which immediately, without the written right of return, immediately eliminates conditions. And even if there's ambiguous statements that we can't tell whether it is conditional or not, makes it unconditional. So in this situation, I would say there's no right of return. It's definitely unconditional. And maybe we have a restriction on it. Maybe. Did you think there's a restriction?
I think there's a restriction because it's tied to a purpose.
Yeah.
But I can also see the argument that this is what they do, and so they were going to do this anyway, and so then the organization kind of continues to move ahead and just gets the work done.
Yeah, and it could be one where there's a simultaneous release too, where because they do this, they're going to do it within the next 12 months or within their fiscal year, that there is a simultaneous release that we can say, yeah, let's just recognize it all because we're going to do it. We're going to do it. This is what we do. We'll get the report. I probably would be less inclined to do that, but I could see that argument for doing it because, like Eric has been saying, it's important that you perform once you receive that donation, once you get that money, and having that financial responsibility and accountability is important. So I'd be inclined to at least track it, even though I know there's a simultaneous release. I want to at least know that we've gone through and done what we say we were going to do.
Because nonprofits should be aware that even if the condition, even if it isn't conditional in an accounting sense of thing, any restriction, there's a donor out there who believes you're going to do something. And if you don't do what you say, you've just lost that donor.
Yeah.
Yeah, absolutely. This example feels like a catch, right?
Yeah, for
This is
sure
a catch. Yeah.
For sure a catch.
Anytime it's close to unconditional, it's got to be a catch, right? More or less, right?
Yeah,
much.
I think that once we've gotten that far, it's definitely a catch, and now we're just maybe just seeing where our knee came down.
Well,
Inbounds are out.
Exactly. It's ball placement at this point.
Yeah.
And how much time should be put back on the clock?
Yeah, there you go. Time back on the clock.
Before we go, because we're starting to bump against the clock here, Erica, Chris, too, will you guys just kind of talk about like why this is so important and why it matters, especially when we're talking about something as important as not-for-profits?
So I always like to remind people that nonprofits are about 15% of the U.S. economy. So really big sector of finances circulating in local communities, in businesses, in organizations. And when either a donor or a board member or an executive director of a nonprofit or a finance manager is thinking about the money that's coming in the door and what it's designed to do and how they need to make sure that it gets to where it needs to go. We should all understand this in some way so that people can be their most effective with their dollars. They can give money that meets the purpose that they want to accomplish. And hopefully it'll invite more people to say, hey, you know what? I'm going to give an unconditional gift because I believe in the mission of this organization. And I can propel that mission forward by giving an unconditional, unrestricted, non-exchange gift.
I agree. I think it's both sides of this coin of making sure these non-for-profits or these exempt organizations that are such a significant part of our economic model to do things the right way and propel them forward. But educating those donors as well is so vital because sometimes they don't intend to make a conditional or restricted gift. Like they want to just do good for this organization. And maybe the words that they used or the language that they put in that agreement weren't really what they wanted, but now that not-for-profit is kind of beholden to what that agreement was. And I think it's important that the donors know. I know after 2018-08 came out, I had a conversation with a local foundation, and they were going to have to change some of the language that they put in their letter because their intention was not to make conditional contributions to these charities, but they were based off the language that were written in their agreement. So they wanted to make sure that they could give administrative costs because that's what was really important to them, to make sure these not-for-profits were still continuing to operate as efficient and effective as they possibly could.
Yeah.
And to tie that back to the NFL, I mean, one of the examples of a famous catch no catch that we didn't talk about was the David Tyree helmet catch in the Super Bowl, in the 08 Super Bowl. And so why does it matter? Because, I mean, for that catch no catch, it made the difference, right? It was a game winning, and a lot of donors and a lot of nonprofits. These contributions are game winning. They change the trajectory of the organization. And so that's my connection back to between the NFL and revenue recognition.
Such an amazing play.
Yeah.
Manning should have been down, though. They should have sacked him like 3 times before he threw that ball. I hung out with David Tyree one night. Yeah. Nice guy.
And I think that's a great example to end on because that was not the most traditional catch you would ever see.
Completely amazing.
Right.
A
Did
remarkable
he have
catch.
Control? Could he have made a football move holding onto that thing on his head?
Have you ever tried to hold a football on your head with a helmet?
Yeah, every Saturday night. What, you don't?
Right. And I think that is a good example of some of these not-for-profits trying to raise revenue, trying to do good, trying to push forward, are trying to do that holding a football on their head.
Agreed. Good stuff, everyone. Erica, Chris, thank you very much. That's it for today's episode of the Trust Us, We're Professionals podcast, brought to you by all of us at SSC CPAs and Advisors. If you ever have any financial questions, financial concerns, financial needs, you can always reach out through our website, www.ssccpas.com. That's www.ssccpas.com. Any parting words, lady and gentlemen?
No.
Okay, then. We'll see you guys next time. Thanks for joining us.
Thanks.
This podcast was recorded and is being made available by SSC Solutions, Inc., together with its affiliates and its employees, SSC, solely for informational purposes. SSC is not providing or undertaking to provide any financial, economic, legal, accounting, tax, or any other advice in or by virtue of this podcast. The information, statements, comments, views, and opinions provided in this podcast are general in nature, and such information, statements, comments, views, and opinions in the receipt of this podcast by any listener are not intended to be and should not be construed as the provision of investment advice by SSC to that listener or generally, and do not result in any listener being considered a client or customer of SSC. The information, statements, comments, views, and opinions expressed in this podcast do not constitute and should not be construed as an offer to buy or sell any securities or to make any investment course of action. The information, statements, comments, views, and opinions expressed or provided in this podcast, including by speakers who are not officers, employees, or agents of SSC, are not necessarily those of SSC and may not be current. SSC does not make any representation or warranty as to the accuracy or completeness of any of the information, statements, comments, views, or opinions contained in this podcast, and any liability thereof, including in respect of direct, indirect, or consequential loss or damage of any kind whatsoever, is expressly disclaimed. SSC does not undertake any obligation whatsoever to provide any form of update, amendment, change, or correction to any of this information, statements, comments, views, or opinions set forth in this podcast. No part of this podcast may, without SSC Solutions Inc.'s prior written consent, be reproduced, redistributed, published, copied, or duplicated in any form by any means.